India's market news headquarters. Cutting-edge analysis. Influential insights. Market-moving intelligence. Broadcasting live from the CNBC TV 18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. First up from all of us here, let me wish all of you, your families, everyone at your workplace, a very happy Diwali. This is the Festival of Lights. I don't know if you can see the full newsroom behind us, but it's decked up, it's looking festive, and we are ready for it. Not just today, but tomorrow as well, because it stretches over 2 days this time. Guys, hi, happy Diwali.
Happy Diwali, Prashant. Happy Diwali, Nigel, and happy Diwali to all of our viewers. The gods and goddesses of prosperity and wealth have been very, very kind to us this year. It's been a good year for the country, for the economy, and of course for a lot of us individually as well. And here is hoping that this Festival of Lights will keep, sparkling more joy, more wealth, and more health in our lives in the year ahead.
Well, indeed, happy Diwali to you guys, and happy Diwali to all our viewers as well, your families, your loved ones. The next few days are going to be heavy for the markets, but I'll tell you what, take a bit of a break, chill pill, and enjoy the festivities because it's that part of the year.
And let's not forget that, India's actually celebrating Diwali on 2 days this year. Yeah. A lot of you, perhaps in the north of the country, are actually doing your pujas today. So, an even more special greeting coming your way. And I think many of us here in Mumbai would be doing this tomorrow.
So basically, I looked up, essentially the Krishna Amavasya, it starts today. I mean, essentially it starts at 3 p.m. today, and it extends till 6 p.m. tomorrow. So it does not end with sunrise tomorrow. I mean, it ends by 6 o'clock in the evening tomorrow. So I think exchanges, that's why, when we will be at the Mahura session, Nigel, you'll be at the NSC, and we'll have someone at the BSE as well. The puja will happen tomorrow afternoon, because, I mean, it's still Diwali. So I think that's the, but as you said, lots of people in the north, Delhi, I mean, a lot of my family, they're all celebrating Diwali today, and we're celebrating Diwali too. Well, let's just sort of turn our focus just a little bit to markets here, because we've got a market which is trading, even if many of you are at home and watching this. So let's just start by telling you what you need to know, and we'll rewind the clock back and take a look at where we left things off yesterday. So equities in the US were slightly lower. And the Nasdaq ended about 0.6 odd % down. There was a bit of a cut which came through. Semiconductor stocks, essentially that is the pack which hurt. That was down 3.5%. SMCI fell 30% plus on auditor resignation. There was, of course, AMD earlier, which had reported numbers. So a combination of these two, both from the semi space, you had a rub-off effect, and that entire space, of course, has been the leader. And that's the reason why the sell-off on Nasdaq was more pronounced. Actually, you can't even call it a sell-off, just a bit of a pullback. Data was strong, though. You look at, I'm going to put out two. There were actually three, but just these two numbers. ADP, which is private payrolls, private job addition, that number came in much stronger than expectations. So 230,000 compared to 110, which was essentially the consensus. The prior number was about 160,000. So this is 230,000 plus. That is one. Second, the third quarter GDP had come out, and many were saying that, well, it's kind of weakish, tepid, etc. But what stood out within the GDP number was the consumer spending part of it. And that was very, very strong. Along with it, in the GDP data, there was also PCE, which is the inflation data, which was subdued. So in a way, it was like Goldilocks, right? Strong growth, but inflation components, which were actually quite weak. And I think that's these are the two macro-ish data points which the market kind of was also responding to. Microsoft and Meta earnings came in. They were okay. I mean, I think stocks in after-hours trading are slightly lower, but I didn't see anything vastly sort of, it was not a big miss or a big beat. They were largely in line. 10-year yield, 5 basis points higher, weighted about 4.3%. By the way, the 2-year went up 7 basis points. But the dollar index cooled off about 0.25% to about 104.09. Typically, they would move in the same direction, both up or both down. So you got a bit of an idiosyncratic kind of move happening, and that largely could also be because of, the dollar index, there's outsized weight of what the euro does. I think 60% of the dollar index is just the euro. So there is that happening. Oil prices 3% higher, 73 plus is where Brent oil prices finally are at. Now, just to circle and tie in the levels here for the market, yesterday we had a bit of a pullback. There was no follow-through from the day before. The Nifty struggled to hold the 40-hourly exponential moving average. That's point number one. But the silver lining was that the broader market breadth looked better. You look at the mid-caps, small caps, micro caps, and it was almost 5:1 in favor of advances by the end of it. So the levels is what we want to put out. On the way down, the Nifty should not break the lows of 24,073, which of course is the recent, and I don't think that should come into focus. It's not very far away, mind you, about 200, 250 points away. But hopefully that does not again come back into play. On the way up, we need to get above the swing low of 24,567. As of day before yesterday's close, we were exactly 100 points away. We are a little bit more to that point. So 24,567 on the way up. The Nifty Bank ended lower. It gave up about 50% of day before yesterday's gains, but it remains above the 20-day moving average. Here, we need to get above two levels, 52,534, and then the 61.8% retracement of the full decline that we've seen from all-time highs to the recent low, which is 52,835. And on the way down, Nifty Bank support comes in at 51,481. So that's essentially the picture that we are going with. Remember, today is the full, sort of, in a way, the last full trading session for the week. Tomorrow, you've got the Diwali holiday, but you've got the markets trading in the evening for an hour or so. So for all practical purposes in that sense, I mean, it's kind of the last session. 100 points lower is what the GIFT Nifty is implying in terms of open this morning. Surabhi.
Oh, yes, absolutely. It's been a tough October, hasn't it? I mean, and I thought as we're kind of winding down this month, it's good to have the numbers in context again. So let's put that up first. This October that the bulls would definitely like to forget. We've got the Nifty down about 5.7%. The mid-cap index has fallen a little more, about 6.5%. Then you have the small cap index down 4, and the Nifty Bank is down 2.2. So relatively speaking, banks have been the best of the lot. How has the world done? The world has done, largely a lot better than us, barring the South Korean market, because the Nasdaq is up 3%. The S&P has managed about a 1.5% gain. Shanghai has been the big story of October, 15% up. Nearly on the Shanghai market or the Hang Seng, whichever one market you're looking at. And even the Japanese market, it's continued its upward trajectory. Will November, end India's massive underperformance? And I think a part of that answer lies in the flow situation, which is still not looking good. Because remember, we came in yesterday and we were talking about just a triple-digit sell, just about 500 crores of FPI selling. Well, guess what? Yesterday, it wasn't like they'd taken off on a Diwali holiday. Not at all. There was lots of selling again, 4,600 crores of selling coming in from the FPIs. And as usual, it was more or less getting offset by the domestic institutional buying. So the flows picture is still not looking good as we are winding up this month. Just a couple of cues coming in from the neighborhood. So the factory numbers from China are again actually very good. After 5 months, we've seen the official PMI go back into expansion territory. So it's above 50 again, which is better than anticipated. I mean, most of the, polls were looking at numbers of around 59.8, 49.7, 49.8. But it's been better than that, the September number. We will be hearing from the Bank of Japan. The expectation is that despite whatever is happening in terms of politics and the recent elections, right now they're not going to change policy at all. They'll stay pat, at that 25 basis points level of the benchmark rate. So let's watch out for what the BoJ has to say and if that triggers any kind of a further move in currencies as well. Important watch points today from China and Japan. Oil, now this uptrend that we saw yesterday overnight, and it's continuing this morning. You can see an additional gain on the screen as well. That's because there's a lot of murmur and chatter in the market about OPEC Plus, which is OPEC Plus Russia, them perhaps not ramping up output as much as they had earlier promised by December, that maybe they're looking at the market and they'll say that we'll just delay this output increase. And that's been triggering that rally in oil prices. Now let's come to some macros here at home as well. To put it in a nutshell, the fiscal deficit situation continues to look really, really great because the numbers for April to September, the first half, look at the deficit. It's 4.75 lakh crores, which is so much lower than the same period last year. So that's the good news. The deficit is tracking lower. We're only at 29% of the full year target in the first half, which is fabulous. Now, the undercurrent here is that the government is not spending as much on capital expenditure as it was doing last year. So if you're a bear, you're going to pick up on that point because that capex number is, of course, lower. Tax collections are great, which is why the overall deficit is coming down. But government spending has been lower in the first half of this year, so that needs to be kept in mind. Speaking of spending and speaking of the macros, we had the September 8 core industries growth number come in. That's looking better. Month on month, we've got some growth at 2%. And, I noticed cement in particular because the cement output has surged 7% higher as the monsoon period gets over. So that's something positive. And finally, again, ending since we're talking economy, I think L&T is the best barometer. We'll spend a lot of time talking about it. Numbers are looking good. They have managed to beat expectations on the top line, on the profit. The margin debate will continue on L&T because the core margin, again, is a little underwhelming. So let's see if the market will want to treat this as a glass half full or empty. The order inflow is also lower. It's actually dropped in the second quarter, but that's a high base effect. Largely, I think L&T numbers are fine. The margin debate shall continue.
Well, that's right. And let's get straight then to the top cues that we got from, overnight. So if you look at the top three indicators, Brent crude prices, still it's pretty much well behaved. It's still holding at around that $72 per barrel mark. The yields, well, they continue to stay elevated at around 4.29% odd, while you have the dollar index, which has cooled off a little bit, and that's a bit of a positive. Well, two big cues coming in. On the domestic front, today we'll have the monthly expiry that plays out on the Nifty, and the bulls have got used to their winning ways, but that streak is going to get broken today because for the month of October, well, the Nifty has seen a correction, and that's after nearly 4 series that we've seen a bit of a downtick. On the global front, we've got a lot of cues because you have the jobs data that'll be out, the inflationary data as well that'll be out from the US, and a lot of earnings as well. So plenty to react to in the next 36 hours or so. Moving to the FI data, well, what did they do yesterday? They unwound some longs, they covered mild shorts as well. And that's why they move back into the net short position. Now the short positions by the FIs are close to around 1.22 lakh contracts, while the clients, they remain net long with close to around 2 lakh contracts on the long side. So both those two data points come up for you on the screen. What happened yesterday? Well, we had a bit of an off day and the call writing came back into play. Remember, we're getting into a monthly expiry and you had call writers that were back into play. 24,600, 24,500, 24,400. Put it together, that's more than a crore shares getting written out there. So the bears believe they have got these upper end covered, added on this 24,500 odd mark, and we visited that mark, and from there we did a bit of a U-turn. So that's going to be the crucial resistance zone. For starters, we're going to be starting off below the 24,300 odd mark. Yesterday we bounced off there. So the 24,250 mark, that's a crucial reference point. Though the firm support comes in at around this 24,000 odd mark, resistance you have out there, and 100 DMA as well comes up for you on the screen. The Nifty Bank is a little bit more interesting. It was giving that sense that it wants to break away, but now it's it's got a couple of reference points, which is the 20 as well as the 100 DMA. You don't want the Nifty Bank to break that 51,500 odd mark, so we're going to be winding down the series. But let's see whether or not the bulls have got some kind of a fight towards the end of trade. It's going to be an interesting one.
Okay, all right, got that, Nigel. So we're going to keep those levels and a lot of those cues in mind as well. So let's kickstart the action as Nigel rejoins us right here. With the equity call of the morning, and this one's coming in from Citi. Surendra Goyal of Citi says that headline EBITDA trends in the second quarter so far are slightly below expectations. Excluding OMCs, EBITDA and PAT growth stood at 6 and 9% respectively year on year. He says while consumer sectors missed earnings, healthcare, industrials and financials continue to deliver relatively decent mid-teens operating profit growth. He adds that the second quarter and the festive demand commentary from non-auto consumer discretionary companies remains something to watch out for. He says after an 8% decline from the peak, the Nifty now trades at near 20 times one-year forward earnings. Both absolute and relative valuations are slightly below the one standard deviation level above the 5-year average. He says their September 2025 Nifty target is 2025, a modest upside from here on.
Okay, so one more call coming in. This is Mahesh Nandukar of Jefferies, who says that strong domestic demand for equities is finally meeting its match on the supply side. He says equity supply is ramped up to $7 billion per month over the last 4, taking the total supply in 2024 so far to $60 billion. He expects the supply to stay strong, while domestic flows would be likely peaking as calendar 2024 equity flow as a percentage of household savings is getting close to the OECD levels. He continues to stay cautious on the markets. Banks, two-wheelers, healthcare, and e-commerce are key overweight sectors for Mahesh.